Hey friends, welcome back. Do you guys know how excited I am to see you today? Once again, I've got a lot of insights to share, so grab a cup of coffee and join me today. You'll learn something new about dividend investing, even if you're experienced, I promise. And if you're a beginner, even better, lots to unpack here. We're finally getting some more levels of peace and quiet in the market. The VIX is under 20, the S&P is above 4,300, and China's crown jewel Alibaba is above $160 a share. This allows me to spend this more relatively quiet time to share some highly educational and research videos for you to prepare your investment strategy as we enter the next stage of the markets once tapering comes later this fall. Now, before we get started, let's recap the pretty bold opinions I've shared on my channel so far. That the Evergrande situation wouldn't be a big problem for the US and Chinese tech stocks, that the improvement in US-China relations could lead to a tech rebound in the Chinese internet sector, and even that Chinese education stocks that seemingly have no future could present alpha if you timed it correctly. Now, during times of intense anxiety and market stress, I will share my research tactical updates on my opinion. Seems like we're doing pretty good so far. Now make sure to join me by subscribing and turning on that notification bell. I obviously won't be right all the time. In fact, some of my opinions might be made a little bit too early, but at the very least, you'll get to see the research opinion of a CFA. When things are a bit more calm, we have the luxury to use this time to learn new skills and gain new insights, which is exactly what I'd like to share with you today. Now, given today's video is about a timeless investment piece on dividend stocks, there will also be a list of dividend stocks in the description below. So definitely put this video in your watch later tab or your queue section so that you can access this video later if you need to. Today, we're going to be diving into the insights about how to eventually live off dividends, the math behind how much capital is needed, how to get there, what's the best strategy based on my research. Most importantly though, I'm going to talk about dividend growth investing in a way other channels on YouTube do not necessarily discuss. Now, I know that most of my viewers are growth investors, but I hope that this video will give you a new set of investment strategies that will help you understand asset allocation during changing investment environments and your personal situation. Now, my research here will even consider tax implications to help you keep more of your dividends if you have them in your portfolio. As the S&P's bull market gets into the later innings of this cycle, it becomes more critical to understand whether dividend growth investing should be a part of your playbook. So let's get started. Dividend growth investing is often praised as one of the best ways to compound savings. And I will talk about all the considerations behind dividend growth investing, specifically in today's market environment. Now, to make sure that we're all on the same page, a quick refresher is that a dividend is essentially a share of the company's earnings that is designed to be paid out to shareholders on a set schedule. Most companies pay dividends quarterly, but some can be made monthly. Now, let me do a quick demonstration of where dividends actually come from so that you can visualize the process. Here I have a balance sheet and an income statement from Walmart. And you can see that the big picture concept is that Walmart brings in sales, they have expenses, and afterwards they are left with profits. Now, these profits are also known as retained earnings. And these retained earnings can be used to add cash to the balance sheet, be reinvested back into the business, or paid out to shareholders in the form of dividends. Now, we can see that Walmart pays out a dividend yield of 1.58%. That essentially means that the company is paying out 1.58% of its net profits to shareholders. So if Walmart had $13.7 billion in net income last year, they paid out $216 million in cash as part of their dividend yield to shareholders. Now, whether you're a beginner or a more seasoned investor, you might have connected the dots that means the dividend isn't exactly free money. If the company pays out a dividend yield to you, then it has less cash on its balance sheet, so its equity value could potentially be reduced. As a result, in return for a dividend paid to you, the company's share price might appreciate at a slower rate. Dividends are paid because management can't find any growth area that can be a better return on investment than the dividend itself. Nothing really comes free in life, and dividends are no different. In fact, some people are lured in by a company's dividend only to find out years later that even with the dividend reinvestment, their total return lagged stocks of some faster growing companies. And if you haven't retired yet, I want to help you avoid these traps. And even if you're a little older, I want to help you protect your capital without compromising the returns that you could get. Now let's talk about the truth about living off dividends. In the US, there is a list of companies known as the dividend aristocrats. These are the companies that have raised their dividends by at least 25 consecutive years. And in a future video, I can actually provide more detail on these specific companies. But for now, know that a lot of very popular ETFs are constructed from the dividend aristocrats list. Now we can see from this table below that I've helped you find the largest dividend devoted ETFs by assets under management, AUM. You can see the ETF that tries to more precisely track the dividend aristocrats is the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL. Now, the current yield on this ETF is approximately 2.3%. This is in comparison to ticker SPY, the S&P 500, dividend yield of 1.78% from 2020. Now, across YouTube, there are several good videos on how much money is needed to live off dividends. I've broken down the math for you to see how much you would need invested to make certain amounts each month. But I'm going to take it one step further and later in this video help you understand how you can make dividend investing a part of your overall strategy as we enter a late cycle bull market where this strategy typically outperforms growth in recessions. Now, as we can see from this table, the math suggests that living off dividends is not exactly feasible for the average American. And given that the average net worth in the US by age is in the table below, we can see that just relying 100% on dividend investing isn't necessarily practical. It even implies at one's retirement age, if one qualifies to be considered average, which by the way is an accomplishment because net worth in the world has a distribution tail skewed far to the right, the annual dividend income wouldn't even be $40,000. You can see from this distribution tail that only a sliver of people in the world can completely rely fully on dividend investing. But here's the real insight. In order to get to that part of the curve where you can fully depend on dividends, I can nearly promise you that they did not use dividend investing to get there. Dividend investing is the end goal and not necessarily the strategy that people, especially younger people, should use as the core strat. So what then, Larry? What then is the strat? The key point here is to realize that the real strategy of dividend growth investing needs to be a supplement to your existing strategy and not a full replacement. It's also very powerful to know an optimal mix of growth and income producing stocks based on your age profile and your specific circumstances. Here's a table that I want to show you that you might find helpful. Of course, this depends on your personal risk tolerance, but the general principle should be that growth investing should be your priority when you're younger, and dividend investing takes a bigger role in your portfolio as you get older. The key insight here is that dividend investing is a way for you to generate some passive income, but that it's more designed as a hedge against market volatility as you get older. Now, most of my viewers are between the ages of 25 and 55, which means that our priority is in growth stocks according to this conventional table. But not so fast. This is where my researched insights come in. This table assumes that we are in a normal, well-functioning bull market. If the S&P 500's bull market is derailed, empirical studies over time suggest that growth stocks are hurt the most, and the dividend aristocrats might have the opportunity to outperform the broader indices because their yield offers some level of cushioning against losses. In fact, during the major downturns since 2000, the Dividend Aristocrats as a basket has outperformed the S&P with lower volatility. Now, we are seeing signs of a late cycle bull market, as I've covered across my channel very heavily. It doesn't mean the S&P 500 has peaked. In fact, I personally don't think it has, but here is the investment environment that we're in today. We have S&P 500 PE ratios north of 30. The inflation core PCE metric is 3.7%, according to the latest FOMC meeting. The Fed is starting to plan tapering later this year. Rate hikes are planned for 2022. There is still great geopolitical uncertainty between US and China, although that's improving. And the effect of stimulus and growth from reopening has largely played out. So this suggests that while the markets have further to run, there may come a point in 2022 where, as a basket, the Dividend Aristocrats might be an attractive part of our portfolios, especially if economic growth slows down. While higher interest rates make Dividend Aristocrats less attractive, higher rates ends up discounting the cash flows of growth companies and hurting their share prices further than high-quality dividend payers. So what I'd like to share with you then is to help you learn a framework for identifying the right dividend growth companies, the right sectors as well, along with fully understanding the risks behind them. And at the end, I'll suggest a list of some high-quality ETFs and some high-quality companies that I think have the attributes of both growth and dividend growth qualities. Here are some considerations behind dividend growth investing up front. First, based on my research, I want to share that it's very rare for high dividend paying stocks to become multi-bagger stocks. Second, you must have the discipline to strongly consider selling a company that has cut its dividend, because that represents a severe problem in the business if you are relying on dividend growth investing as your core strategy. And third, you need to know that higher dividend yields are not always a positive. To dig a little deeper, one of the things that I would do if I were in the market right now for dividend investing is to understand where we are in the economic cycle. Because I've already concluded that we are in a late cycle bull market where inflation is creeping up and interest rates are on the rise, we need to be very attentive to what sectors and industries we are choosing dividend companies from. Like I mentioned in a previous video where I talked about inflation and showed the table of sectors that are likely to perform during periods of high inflation, I want to show you this table here again and the takeaways from it. You can see that this table isn't just a compilation of my opinion, it is also drawn from the research of global asset manager Fidelity. And this is the same kind of advice they tell their clients. This table is also indirectly a guide as to what types of sectors and industries to avoid or focus on when identifying companies that could be promising for our dividend picks. As an example, even though utility companies are generally known for having higher yields, their dividend is less attractive as interest rates rise. And utility companies sometimes have price ceilings due to regulation. So the current inflation environment eats away at their earnings power, and their yield does not make up for the underperformance in the market. Now, the biggest skill that you can have as an advanced dividend investor is by predicting which companies will hike or cut their dividend, similar to how growth investors focus on which companies will unexpectedly have high or low earnings per share outcomes. Now, if you can properly understand which companies could hike dividends in the future, you will not only get higher dividends from the company, but you'll also experience growth-like returns to help you get the best of both worlds, because institutional investors are always hunting for yield. Now, here are some insights that I've learned when I was working in investment research. Believe it or not, when it comes to dividend investing, a big part of the analysis is associated with credit research. We have to understand the free cash flow generation of the companies and look at certain metrics that will help us understand whether the dividend is safe or whether there is more room for the dividend to grow safely. Some patterns and observations that you could be paying attention to help you know whether a dividend raise or a dividend cut could be coming is through the following case studies that I'll share with you right now. One very powerful metric that you can follow is how much of the equity value is currently consumed by cash per share. As an example, Apple is famous for having a very low dividend, despite having a large cash pile on its balance sheet. Apple actually has so much cash on its balance sheet that some institutional investors are wondering whether it has the ability to find a proper return on its cash through mergers and acquisitions and also through research and development. If Apple is unable to, the company might be pressured to increase its dividend of currently 0.6%. Should Apple do that, it's likely to attract a different crowd of investors, and the stock might be included in the list of dividend ETFs, which would create buying pressure for the company's shares, pushing the stock up in the short to intermediate term. However, do note that in the longer term, the key is to know that since a dividend is now being issued, Apple will have the obligations to pay out dividends each quarter and therefore have less cash for research and development and M&A to pursue growth. And by doing so, a dividend hike at Apple would start the transition from Apple being a growth stock in people's portfolios to becoming a value/income play in people's portfolios. And since the growth ETFs attract the most assets under management, it's possible that these ETFs might rebalance out of Apple and therefore slow down the longer-term trajectory of Apple shares. Another market metric that you want to focus on is whether the company is exposed to commodity prices. Now, during the oil crisis, when crude oil futures were temporarily below $0 per barrel in 2020, energy companies where they had a payout ratio of 70% or more of their earnings to dividends were in imminent danger of a dividend cut. Now, when we look at the energy sector, even though the yields are definitely very attractive, we have to remember that these companies are dependent on oil prices staying above a certain threshold. And number two, the payout ratios, which is the percentage of net income that the dividend takes up, is very high within the energy sector. That essentially means that when we enter a period of stagnation or deflation and oil prices fall, these companies' dividends are going to be constantly revisited among management's plans. Now, if you thought that was basic, then allow me to share with you what institutional investors might be doing when doing additional research on dividend-paying stocks. I know this because I've worked on that side of the industry before. Now, many institutional investors look at the Altman Z-score, and they also look at ETF flows. So let's take a look at what the Altman Z-score is first. The Altman Z-score is a proxy for bankruptcy risk and is used in both credit investing and also in dividend investing. The model of Altman Z measures the following criteria: working capital over total assets, retained earnings over total assets, EBIT over total assets, the market value of equity over the book value of liabilities, and sales over total assets. Now, what this score will do is it will tell investors a broader picture of the liquidity health of companies and give investors a sense of how durable the dividend is and whether there are risks to a dividend cut or room for a dividend hike. So as you can see, we don't want to blindly buy companies just for their dividend yield. Instead, there is a more sophisticated process behind how institutional investors pick the best dividend companies. Picking a wrong dividend stock in the wrong sector at the wrong time could lead to stock capital depreciation that wipes out any gains from the dividend yield itself. And when we look at the chart below, we can see that even a little bit of research into understanding the Altman Z-score and the payout ratios of companies over time and the sectors they belong in go a very long way to optimizing your returns in different market cycles. Now, for a quick overview of how taxes work, and this is very important, so pay attention here, when it comes to dividend investing, is this. Now, in the future, by the way, I'll have far more detailed research on taxes, so this is just the tip of the iceberg. So you'll want to know that dividend income has two types of tax statuses. One is ordinary dividend status, and the other is qualified dividend status. Now, since dividend income is taxed at the ordinary rates for certain investments, it's actually better to own these stocks when you're older and you have less W-2 income, which is another way of saying income from an employer. Now, even if you don't sell your stocks, it's very important to know you still have to pay taxes on the dividends. That's an important piece to know. If you don't sell your stocks, you still have to pay taxes on the dividends. Now, the dividends can be taxed as ordinary dividends or qualified dividends depending on the criteria that I'll show you here in a moment. Now, as you can see, you'll end up paying a lot of taxes, whether they're ordinary or qualified, because you're more likely at a higher tax bracket when you're between the age of 25 and 55 than when you're retired. Now, in terms of what the difference is between ordinary dividends and qualified dividends, I created a table here for your reference. So once again, you can put this video in your Watch Later tab or in your Queue tab so that you can access this table in the future. You can see in this table that to qualify for ordinary dividends or qualified dividends tax status, there are certain notes here. So let's start with ordinary dividends. If you buy REITs for stocks or MLPs, then most definitely those dividends are going to be treated as ordinary dividends, which are based, by the way, on your marginal tax rate. So the higher your income, the more taxes that you're going to pay from ordinary dividends. Now, for qualified dividends, these are taxed at capital gains rates, and the criteria is that the company needs to trade in the US, and you typically need to be a longer-term shareholder. The finer details is that you have to hold this company for at least 60 days inside a specific ex-dividend date. I'll include more details on that in the description below. But as you can probably see, making sure that dividend growth investing is just one part of your strategy is the ultimate goal towards actually living off dividends in the future. Now, as for my thoughts on what ETFs and companies that I think offer great dividend growth prospects along with appreciation potential, here's my thoughts on the ETF side. I think that the Vanguard Dividend Appreciation ETF is appropriate for investors who want a blend of both growth and income. Now, we can see here with Microsoft holding the largest weighting, there is growth potential in this ETF as well. The top holdings include market-leading companies that, in my opinion, have very little chances of dividend cuts based on where they are positioned in their sector and also the sector itself. So this ETF, in my opinion, is quite solid. Of course, you have to do your own research because this video isn't financial advice, so make sure to do your own diligence, but that's my opinion. Now, this is the most popular ETF by AUM, and this makes sense because of their low fees and holdings composition. Now, in terms of my thoughts on companies that I am personally invested in, I tend to go for companies that prioritize growth prospects while still having a decent dividend close to the 10-year yield. Now, I have two separate portfolios. One of them is very aggressive, the kind of companies that you've seen me talk very widely on in my channel, Chinese internet and US tech. The other portfolio that I have is much more buy and hold, and it consists of very high quality companies but with a lower degree of risk. Some companies that can be considered to be hybrid and income producing, in my opinion, include Costco, Visa, and Home Depot. Now, I don't actually own many stocks in the high yield sectors like energy or financials. And I know that energy and financials are supposed to do well in inflationary periods like we are in today and offer good yield, but I have to be really honest, those sectors are outside of my expertise. And Peter Lynch says it best, invest in what you know. So the truth of the matter is this, in order to live off dividends in the future, we need to take appropriate risks today to have the portfolio size to make that strategy feasible. Those appropriate risks will involve understanding inflation and the economic outlook. And when the market was down, venturing into higher growth companies like I did with Chinese internet. Now, I did say that several months ago that I went pretty big into the Chinese internet sector. And although that play was highly unpopular and attracted quite a bit of skepticism, if you've been following my research and insights for a while now, let's just say very humbly that we've been on the right side of the trade. Now, during times of market volatility, you can expect me to step in on YouTube and help you understand the bigger picture and whether that fear is warranted or not. Because sometimes, let's be honest, that fear could be warranted. Now, during times of relative market calm, like at the time of this recording, I'll produce evergreen educational content to help you elevate your investment game as we enter the next stage of the markets. Now, how do we follow these insights? Make sure to turn on that bell after subscribing and check my community tab for updates. And I've got an email list that I'm putting together to send out periodic investment research notes in early 2022. Links in the description below if you're interested. If you want to learn how inflation might play a role in the context of your investment strategy, make sure to click this video here. And if you want to know why I thought the Chinese internet sector was going to rebound several weeks ago before it happened, click here. I want to let you guys know you guys are very awesome. I hope you know that. I'll see you next time.